In 2008, the global financial system collapsed. Banks that had gambled with mortgages, derivatives, and toxic assets brought the world economy to its knees. 15 million Americans lost their jobs, 10 million families lost their homes, retirement accounts evaporated, small businesses closed. It was the worst economic crisis since the Great Depression. And the banks that caused it, they were rescued with your money. $700 billion of taxpayer funds went to save the institutions that destroyed millions of lives. Not a single major bank was destroyed. Not a single executive went to prison. Instead, they got bonuses. The question isn't why the crisis happened. The question is why were the criminals rewarded while their victims were punished? Here, where history, power, and economics meet, we reveal the truths that shape civilizations. September 15, 2008. Lehman Brothers, one of the largest investment banks in the world, filed for bankruptcy. It was the largest bankruptcy in American history. 158 years of operation gone overnight. The stock market plunged, credit markets froze, panic spread globally, governments scrambled to prevent total collapse. But here's what they don't tell you: Lehman Brothers wasn't allowed to fail because it was guilty. It was allowed to fail as a sacrifice. To make the rescue of everyone else politically acceptable. Because the truth is, every major bank on Wall Street had done exactly what Lehman did. They had all gambled recklessly. They had all sold toxic mortgage-backed securities. They had all leveraged themselves to catastrophic levels. The difference: some had better political connections, some were deemed systemically important, some were too big to fail. And Lehman was expendable. To understand how this happened, we need to go back to the late 1990s. In 1999, the Glass-Steagall Act was repealed. This was a law from 1933 that had separated commercial banking from investment banking. Its purpose was to prevent banks from gambling with depositors' money. For 66 years it worked, but banks wanted more profit. They wanted to take deposits and use them for high-risk speculation. So they lobbied. They donated to politicians. They promised economic growth. And in 1999, President Clinton signed the repeal. The firewall was gone. What followed was predictable. Banks merged. They became massive financial conglomerates, doing everything: taking deposits, making loans, trading derivatives, underwriting securities, running hedge funds. They became so large and interconnected that their failure would threaten the entire financial system. They became too big to fail, and they knew it. With that knowledge came moral hazard. If you know the government will rescue you, why be careful? Why manage risk? Why worry about consequences? You maximize profit, you take insane risks, and if it works, you get rich. If it fails, taxpayers bail you out. Heads you win, tails someone else loses, and that's exactly what happened. In the early 2000s, banks discovered subprime mortgages. These were loans given to people who couldn't afford them, high risk but also high reward. Banks made these loans, then bundled them into securities called mortgage-backed securities, or MBS. They sold these securities to investors worldwide, claiming they were safe. Rating agencies paid by the banks gave them AAA ratings, the highest possible, but they weren't safe, they were toxic. The banks knew this. Internal emails later revealed that executives called their own products crap and garbage. But they sold them anyway because they made huge commissions. Traders got million-dollar bonuses for selling these securities, and when the mortgages inevitably defaulted, the banks didn't care. They had already passed the risk to someone else. Pension funds, insurance companies, foreign governments, they all bought the toxic assets. And when the housing bubble burst, everyone holding those securities lost fortunes. But here's the key: banks didn't just sell these securities. They also bet against them. Goldman Sachs, for example, sold mortgage-backed securities to clients while simultaneously shorting those same securities. They were betting their own products would fail. And when they did, Goldman made billions. It was fraud. It was insider trading. It was criminal, but no one was prosecuted. When the crisis hit in 2008, the government faced a choice: let the banks fail and restructure the financial system, or rescue them and preserve the status quo. They chose rescue. Why? Because the people making the decision were former bankers. Treasury Secretary Henry Paulson, former CEO of Goldman Sachs; his successor Timothy Geithner, former president of the New York Federal Reserve, which is controlled by banks; Ben Bernanke, chairman of the Federal Reserve, an academic who believed in rescuing financial institutions at any cost. These men didn't see the banks as criminals. They saw them as victims of a liquidity crisis. They believed the system was fundamentally sound, just temporarily disrupted. So they crafted the bailout, $700 billion through TARP, the Troubled Asset Relief Program. But that was just the visible part. The Federal Reserve secretly lent $16 trillion to banks, both domestic and foreign. $16 trillion, that's more than the entire US GDP at the time. Where did that money go? To the same institutions that caused the crisis. Bank of America received $45 billion. Citigroup got $45 billion. AIG, the insurance company that had sold trillions in credit default swaps it couldn't pay, received $182 billion. Goldman Sachs got $10 billion officially but received tens of billions more through AIG's bailout because AIG owed Goldman money. It was a backdoor bailout. Taxpayer money went to AIG and AIG immediately paid Goldman. The government knew. They approved it. Meanwhile, homeowners received almost nothing. Millions of families were foreclosed on. They begged banks for loan modifications. They asked for help. Banks refused. Even though the government had given banks money specifically to help homeowners, banks chose not to. Why? Because foreclosure was more profitable. Banks could seize homes, sell them, and collect insurance on the mortgages. Helping homeowners meant taking a loss, so they didn't. The human cost was staggering. 10 million people lost their homes between 2006 and 2014. Families were evicted. Children were forced to leave schools. Elderly people lost homes they'd lived in for decades. Suicides increased. Mental health crises surged, communities were devastated, and the banks, they paid themselves bonuses. In 2008, the same year they were bailout out, Wall Street paid $18 billion in bonuses. For destroying the global economy, they rewarded themselves. And not a single major executive went to prison. The Department of Justice prosecuted almost no one. They claimed cases were too complex, too difficult to prove, but that's a lie. After the savings and loan crisis in the 1980s, over 1,000 bankers were prosecuted. Over 800 went to jail. The laws hadn't changed. The evidence in 2008 was overwhelming. Emails showed intent. Documents proved fraud. Whistleblowers came forward, but prosecutors chose not to act. Why? Because the banks were too powerful. They had lawyers, lobbyists, political connections. They donated to both political parties. They hired former government officials. They controlled the revolving door between Washington and Wall Street. Prosecuting them meant going to war with the most powerful institutions in America, and the government didn't have the courage. So instead, they fined them. Banks paid billions in settlements. Bank of America paid $16 billion. JPMorgan paid $13 billion. Goldman Sachs paid $5 billion. Sounds like a lot, right? But consider this: those fines were tax deductible. The banks wrote them off as business expenses, and the fines were far less than the profits they'd made from the fraud. It was a cost of doing business, a speeding ticket for crashing the global economy. And here's the most disturbing part: the banks got bigger. Before the crisis, the 5 largest banks controlled 40% of U.S. banking assets. After the crisis, they controlled 50%. Too big to fail became bigger to fail. The government forced failing banks to merge with healthy banks. Bear Stearns was absorbed by JPMorgan. Merrill Lynch was absorbed by Bank of America. Wachovia by Wells Fargo. The crisis that was supposed to teach us about the dangers of size instead created even larger monsters. This wasn't an accident, it was policy. The government believed that large banks were more stable, easier to regulate, more efficient. But that's nonsense. Large banks are harder to regulate because they have more resources to fight regulation. They're more complex, more opaque, more able to hide risk, and they have more political power, which means when they fail, the consequences are catastrophic, and the government has no choice but to rescue them. This is the system. It's called too big to fail, but it should be called too big to jail. If you're large enough, powerful enough, connected enough, you can commit crimes without consequence. You can destroy millions of lives and walk away wealthy because the system protects you. The regulators you're supposed to fear. They want jobs at your bank when they leave government. The prosecutors who should jail you. They want to join your law firm. The politicians who should hold you accountable. They need your campaign donations. This is regulatory capture. When the regulated control the regulators. When banks write the rules that govern banks, and it's not a conspiracy, it's structural. The people with expertise in banking are bankers. So when government needs advisors, they hire bankers. And those bankers bring a worldview that prioritizes financial stability over justice, institutional preservation over accountability. After 2008, Congress passed the Dodd-Frank Act, supposedly the most comprehensive financial reform since the Great Depression. It created new regulations, new oversight, new consumer protections, but it didn't break up the banks. It didn't prosecute criminals. It didn't fundamentally change the system, and banks immediately began lobbying to weaken it. They succeeded. Over the next decade, key provisions were rolled back. The Volcker Rule, which limited proprietary trading, was gutted. Capital requirements were loosened. Stress tests were made easier. By 2018, Dodd-Frank had been significantly weakened, and banks were back to their old tricks. Today, the financial system is more dangerous than it was in 2008. Banks are larger, they're more leveraged, they're more interconnected, and they know they'll be rescued. Moral hazard is worse than ever. Why would banks be cautious when recklessness is rewarded? Why would they limit risk when taking massive risk is profitable and failure is someone else's problem? The Federal Reserve's response to COVID-19 proved this. When the pandemic hit in March 2020, markets crashed, and the Fed immediately intervened. Not with 700 billion like in 2008, with trillions. They bought corporate bonds, junk bonds, mortgage-backed securities. They gave unlimited liquidity to banks. They inflated asset prices to record levels. Who benefited? Asset owners, the wealthy, banks, corporations. The stock market reached all-time highs while 40 million Americans filed for unemployment. This is the pattern. Every crisis, the same response: rescue the powerful, abandon everyone else. Socialize losses, privatize gains, make the public pay for the mistakes of elites, and call it necessary, call it saving the economy. But it's not saving the economy. It's saving a system that benefits a tiny fraction of people at everyone else's expense. The truth they don't want you to understand is that banks weren't saved in 2008 because they were necessary. They were saved because they were powerful. There were alternatives. The government could have nationalized failing banks, fired management, restructured them, and sold them back to the private sector once stable. This is what Sweden did in the 1990s during their banking crisis. It worked. Banks were cleaned up. Taxpayers made a profit. No moral hazard was created, but America didn't do that. Why? Because it would have meant admitting that private banks had failed. That capitalism without government intervention destroys itself, and that's ideologically unacceptable. So instead, we got the worst of both worlds. Banks were rescued with public money but remained private. They kept their profits. They kept their power. They kept their executives. They kept their bonuses. Socialism for the rich, capitalism for the poor. When you fail, you ray on your own. When they fail, we all pay. This isn't a free market, it's a rigged game. And the riggers are the ones who write the rules. The question isn't whether another crisis will happen. It will. The question is whether we'll respond differently, whether we'll finally hold banks accountable, whether we'll break them up, regulate them seriously, or replace them with public alternatives, or whether we'll do what we've always done: rescue them, preserve them, and pretend next time will be different. History suggests we'll do nothing, because the people in power benefit from the current system. Politicians receive campaign donations from banks, regulators want jobs at banks, economists are funded by banks, the media is owned by people who own bank stocks. Everyone with power has an incentive to maintain the status quo, and everyone without power lacks the means to change it. But understanding this is the first step. Recognizing that the system isn't broken, it's working exactly as designed. Recognizing that crises aren't accidents, they're features. Recognizing that the banks that should have been destroyed in 2008 were protected because destruction would have threatened the wealth and power of elites. And recognizing that until we fundamentally restructure finance, this will keep happening. The banks won in 2008, they were rescued, they were rewarded, they were made stronger, and they learned nothing except that crime pays if you're big enough. That's the truth, that's the system. And that's why no bank was destroyed. If this gave you a new perspective on how power and money really work, subscribe. History has the answers. It'll show you where to look.